You've got $10,000. Maybe you saved it. Maybe it was a bonus. Maybe it's just been sitting in your checking account, making you feel like you should do something with it. And you've heard the debate your whole life. Buy real estate, it's the only real asset. Just put it in index funds and forget it. Two camps, both confident, both with success stories. So which one actually builds you wealth? Because here's the truth, nobody in either camp wants to admit. The answer depends entirely on when you're asking. And right now, in 2026, the math has shifted in a way that most people haven't caught up to yet. By the end of this video, you'll know exactly what to do with that $10,000, not based on what your uncle did in 2003, but based on what the numbers say today. Let's get into it. This debate has been around forever, but 2026 has made it sharper than it's ever been. Here's the macro picture in 30 seconds. The Federal Reserve has kept interest rates elevated for 3 years now. The Fed funds rate is still sitting above 4%, and that single fact, more than any other, is the invisible hand behind this entire decision. Because high rates don't just affect borrowing costs, they change the entire risk-reward equation between these two asset classes. When rates were near zero in 2020 and 2021, borrowing money was almost free. Real estate looked like genius. Leverage was cheap. Cash flow was real. That environment is gone. Right now, the average 30-year fixed mortgage rate is 6.52%. That's this week's number from Freddie Mac. And the median US home price is sitting around $410,000. Do that math. A 20% down payment on a median home is $82,000. You're not getting there with $10,000. Not even close. But even if you could, at 6.5% interest, your monthly payment on the remaining balance is over $2,100 before taxes, insurance, and maintenance. That's the macro context. Hold on to it, because it changes everything. Now, let's be honest about real estate, because the people who love it aren't wrong. Real estate has 4 ways to make you money simultaneously, and no other asset class does this. 1. Appreciation. Home values have risen an average of 4 to 5% annually over the long run. Not spectacular, but real. 2. Cash flow. If you buy a rental property right, tenants pay your mortgage while you build equity. That's leverage working for you. 3. Tax advantages, depreciation deductions, mortgage interest write-offs, 1,031 exchanges. The US tax code is genuinely generous to real estate investors. This can add 2 to 4 percentage points to your effective annual return compared to stocks. 4. Inflation hedge. When prices rise, so do rents and property values. Real estate is one of the few assets that actually benefits from inflation. And here's the kicker. Real estate gives you access to leverage that no other individual investment does. Banks will lend you 75 to 80 cents for every dollar of real estate you buy at a 30-year fixed rate. That is an extraordinary deal. In the right environment, a $62,500 down payment on a $250,000 rental generating $1,800 a month in rent can deliver total economic returns of 24 to 35% on your invested capital in a single year. Once you factor in appreciation, cash flow, and tax benefits, that is real. This is a massive, but none of that applies to $10,000, and very little of it applies to 2026. Let's be specific, because this is where the conversation usually gets dishonest. With $10,000, you have 3 real estate options. Option 1, direct property purchase, completely off the table. The typical home buyer today needs 7 years to save a standard down payment, according to Realtor.com. At current prices, your $10,000 is roughly 1/8 of what you'd need just to get in the door, and that's before closing costs. Option 2, REITs, real estate investment trusts. You can buy these like a stock. They give you real estate exposure, dividend income, some tax advantages. They're legitimate, but you're giving up the leverage, the depreciation deductions, and the direct control that make real estate special as an investment. Option 3. Real estate crowdfunding and syndications. Platforms like Fundrise or Realty Mogul let you pool money with other investors into larger properties. Lower minimums, but also lower liquidity, platform risk, and lockup periods of 3 to 7 years. Here's the honest summary. At $10,000, you cannot access the version of real estate that actually creates generational wealth. You can buy a derivative of it, a REIT, a syndication, but not the thing itself. And in a 6.5% rate environment, even if you did have enough for a down payment, the math on many rental properties barely works. Cash flow is thin. The buffer for vacancies and repairs is almost non-existent. The interest rate environment has quietly made real estate investing, real estate investing, a game for people with significantly more capital than $10,000. Now let's talk about the boring option, because boring in finance is often just another word for working. An S&P 500 index fund gives you ownership in 500 of the largest American companies, Apple, Microsoft, Berkshire Hathaway, JP Morgan, in a single transaction. And the track record is not subtle. The S&P 500 has returned an average of roughly 10% annually over the long term. In 2023, it returned 26.3%. In 2024, 25%. In 2025, another 17.9%. 3 consecutive years of exceptional performance. Even accounting for rough years like 2022, the 5-year annualized return for top index funds is sitting around 13.6%. Top funds to consider right now: VOO from Vanguard charges just 0.03% in fees. FXAIX from Fidelity charges 0.015%. These are essentially free to own. Your $10,000 invested today at a 10% average annual return becomes roughly $26,000 in 10 years, without you doing a single thing. No tenants to manage, no roof to replace, no mortgage to qualify for, no rate environment to time. But here's what index funds actually give you that nobody talks about enough: liquidity. If you need that money in an emergency next year, you can have it in 3 days. Try doing that with a rental property. Simplicity. You can start with $1. You can automate it, you can ignore it, and it will still compound. Consistency. The S&P 500 has never delivered a negative return over any rolling 20-year period in history. Not once. That's not a sales pitch. That's just the historical record. Let's put them head to head. Same $10,000, same person, 10 years. Scenario A index funds, $10,000 in VOO today. Assume 9% average annual return. Slightly conservative. In 10 years, approximately $23,700. Zero effort, full liquidity throughout. Scenario B, real estate at $10,000. You deploy it into a REIT or crowdfunding platform. Assume 7% annual return, all reasonable for that structure. In 10 years, approximately $19,700, but with lower liquidity, platform risk, and capital you couldn't access for years. Scenario C, real estate with enough capital. You somehow get to a full down payment on a $300,000 rental. At current rates, with modest appreciation and break-even cash flow, over 10 years, total returns could reach $80,000 to $100,000 on your initial equity. That's the real estate dream. But it requires $60,000 to $80,000 to start, not $10,000. The takeaway isn't that real estate is bad. It's that real estate's superpower is leverage, and $10,000 can't buy you meaningful leverage in today's market. Index funds, by contrast, are perfectly sized for $10,000. They work just as well at that amount as they do at $10 million. Here's the macro layer that ties it all together. We are in a higher for longer interest rate environment. The Fed is expected to hold rates steady through at least the end of 2026. Analysts expect the average 30-year mortgage rate to remain in the 6 to 6.5% range for the foreseeable future. What does that mean for your $10,000 decision? High rates are a tax on leverage. and real estate runs on leverage. Every percentage point increase in mortgage rates reduces what a given rental property can cash flow. At 3% rates, a $300,000 rental could generate $500 a month in positive cash flow. At 6.5%, that same property might break even or lose money. Meanwhile, high rates haven't meaningfully hurt index funds. In fact, many of the companies inside the S&P 500, particularly financials and energy, benefit from a higher rate environment. There's also a housing affordability crisis that isn't going away. The typical home buyer now needs 7 years to save a down payment, double the pre-pandemic average. The homeownership rate just hit its lowest level since 2019. That suppressed demand keeps a ceiling on how much appreciation you can expect from property purchases in this environment. The macro wins right now are at index funds' back and in real estate's face. So here's the verdict, and unlike most financial media, I'm going to give you one. If you have $10,000 to invest right now, put it in a low-cost S&P 500 index fund. Not because real estate is bad, but because at this amount, in this rate environment, index funds are the correct vehicle. Full stop. Here's your practical action plan. 3 steps this week. Step 1. Open a brokerage account if you don't have one. Fidelity and Vanguard are both free and excellent. If you have a 401k at work, use it, especially if your employer matches contributions, because that match is an instant 50 to 100% return on your money. Step 2. Buy VOO, FXAIX, or any of the major S&P 500 index funds. They all track the same index. Pick the one with the lowest fee available to you. Step 3. Set up automatic contributions. Even $100 a month on top of your $10,000 will dramatically accelerate your compound growth. Automate it and stop watching it. Now, when does real estate make sense? When you have enough capital to put a real down payment on a real property in a real market where the numbers cash flow. When rates come down and that leverage math improves. When you've built a liquid financial cushion first and you're ready to take on the active responsibility of being a landlord. Real estate will have its moment again, but $10,000 in 2026 isn't that moment. The financial industry wants you confused. Confused people buy products. Confused people pay advisors. The math isn't actually complicated. You have $10,000. You have one rate environment. You have one answer. If this video helped you cut through the noise, like it, share it with someone who's sitting on cash wondering what to do. And if you want to understand why the Fed is keeping rates high and what it means for your financial future, I've covered that in depth in the link above. See you in the next one.